Hey folks, welcome back. And today we are going to look at the Forex broker. A Forex broker is a financial service firm that offers access to market platform for buying and selling foreign currencies. Retail traders must trade through a Forex broker because they have little capital. Also, financial service firms that trade on behalf of their customers and some investment banks must trade through a broker. This makes a broker a very key person in Forex trading. A broker must be regulated within the jurisdiction of operation. Roles of a Forex broker. The number one and the key role of a Forex broker is to enable order execution by connecting a trader to the Forex interbank market. Also, a broker should offer support to their clients. Additionally, a broker should provide trading platform that is easy to navigate or to use. On the other hand, a broker should offer leverage. Client protection is another role of a broker. And finally, a broker should provide as many tradable assets as possible. This role of a broker are also considered as factors that one should consider when choosing the right broker to trade with. Remember, there are thousands of brokers and you really need to do research in order to know the broker that is best suited for you. But to narrow it down, the key thing that you need to look for a broker is that the broker should be regulated in the area of jurisdiction. For instance, if you are in Kenya, you need to choose a broker that is regulated and licensed to do business in Kenya. Another aspect that you need to consider is tradable assets. Does the broker offer you many tradable assets that you can choose from? The other aspect is customer service. A broker should be customer friendly. You want to choose a broker that offers excellent customer service such that when you need their support, they are available. You are able to connect with them through live chats, through email, through phone call, etc., etc. Also, a broker that has fast execution such that when you hit the buy or sell button, your orders are not delayed to be executed. Who are the key participants in the Forex market? We have commercial banks, we have central banks, and governments, corporations, investment funds, and traders. These key participants play a very critical role in the Forex market and they influence the Forex market in one way or another. Let's look at the commercial banks. When we talk about commercial banks, I want you to understand that these are world's largest banks and their key role is to determine the exchange rates based on demand and supply. These commercial banks together form what we call the interbank market, and they take huge amount of Forex transaction each day for their customers and for themselves, since they are also in business of making money. Examples of commercial banks include Citigroup, Dutch Bank, Barclays Capital, UBS, among others. In the next category, we have the central banks and governments. Governments, they participate in the Forex market, or governments, they influence the Forex market when they set economic goals and also when they make political decisions. A good example, during the previously ended US election, the market was very volatile for the USD. So this is an example of political decision affecting the market. Brexit, it's another political decision that affected the UK Forex market. The GBP was very volatile during the Brexit. The resignation of the UK Prime Minister also affected the market, especially the GBP. Just like companies, national government also participate in the Forex market when conducting their operations. For instance, during international trade payments, handling foreign exchange reserves, among others. Central banks affect the Forex market when they adjust the interest rates to control inflation. By doing this, they can affect the currency valuation. Examples of central banks include Bank of England, Federal Reserve, European Central Bank, among others. The key thing to note here is each country has its own central bank. Then we have the corporations, and these are companies that take part in foreign exchange market for the purpose of doing business. A good example, let's look at Apple. Apple manufactures electronics such as laptops and mobile phones. When they want to purchase raw materials, let's say from Japan, they need to convert the USD, since Apple is in the United States, into Japanese yen so that they can be able to pay for the raw materials. During the conversion, they participate in the Forex market, and this affects the USD JPY foreign exchange market in such that these companies do not exchange little amount of money. They deal with huge amount of capital, such that when those transactions are placed, they affect that particular market. The other way corporations participate in the foreign Forex market is through hedging. And hedging is a measure to protect profits occasioned by currency fluctuations. For instance, I will use Apple. When Apple realizes that USD is likely to fluctuate in value, they will tend to look for a currency that anticipates to increase in value so that they can convert the USD and save their money in form of another currency. That currency that is anticipated to increase in value. In doing so, they are participating, or they are doing what we call hedging. Then we have investment funds, and these are organizations or companies owned, or firms. These are organizations or firms owned by highly skilled investors who have a broader selection of investment opportunities. And these investment funds manage funds on behalf of their clients and give them favorable returns from the investments. The last category, we have traders, and these are people with risk appetite who come to the market to earn good returns. These are retail traders. This is me and you. We fall in this category. The structure of Forex currencies. Currency symbols have 3 letters. For instance, USD, GBP, JPY. All these have 3 letters. The first 2 letters identify the name of the country, and the third letter identifies the currency name. USD, US stands for United States, and D is the dollar, the currency of the United States. CAD stands for Canadian dollar, CA stands for Canada, and D stands for dollar, that is the currency of Canada. GBP is the Great British Pound. GB stands for Great Britain, and P represents the pound, that is the Great British currency. Basically, Forex trading entails buying of one currency and selling another. You need to understand that currencies are traded in pairs. For instance, we can have a pair like GBP USD, that is Great British Pound against United States dollar. The exchange rate, which is the price, oscillates depending on the strongest currency at the moment. How do you read a Forex quote? In a currency pair, we have what we call base currency and quote currency. As denoted, currencies are quoted in pairs. A base currency is the first currency on the left. For example, if we have GBP JPY, the base currency is GBP. If we have USD JPY, the base currency is USD. Quote currency is the second currency on the right side. This is also referred to as the counter currency. For example, in GBP JPY, the quote currency is JPY. In GBP USD, the quote currency is USD. In USD JPY, the quote currency is JPY. One thing that you need to understand in Forex, it basically involves 2 things. That is buying and selling. Let's look at the buying scenario. When buying, the exchange rate signifies how much one has to pay in units of the quote currency to buy 1 unit of the base currency. For example, GBP JPY at an exchange rate of 159.653, this means that one has to pay 159.653 Japanese yen to buy 1 GBP. When selling, the exchange rate signifies how many units of quote currency a trader gets for selling 1 unit of the base currency. For example, GBP JPY at an exchange rate of 159.653, this means a trader will receive 159.653 Japanese yen when he or she sells 1 GBP. Therefore, the base currency is key. Everything, whether buying or selling, it's equated to 1 unit of the base currency. Many people wonder how we make money when trading Forex. And today I'll tell you that we make money when trading Forex through buying and selling. The exchange rate is the ratio of one currency valued against another currency. The key thing is buying low and selling high. And how to know when to buy or to sell is through projection, which is done through analysis. As I mentioned earlier, we have three types of analysis: fundamental analysis, technical analysis, and sentimental analysis. Forex trading entails exchanging one currency for another with an expectation of price changes. This expectation is built through the kind of analysis one is able to do. Therefore, if we buy, we anticipate the value to rise compared to the one we sold. If we sell, we anticipate the value to decrease compared to the one we bought. Thank you so much. See you in the next video. Remember to like, subscribe, and turn on notification so that you don't miss my next video.